Well, let's get into those terms right now. We're seeing futures under very heavy selling pressure right now. The S&P and the Nasdaq both down more than 1%. What do you make of this? Because we did finish higher on Friday, found those Jay Powell comments. What do you think is leading to this shift in sentiment?
Well, I think this is a carryover from the jobs numbers we saw on Friday, Frank, and the layoff numbers that we saw on Thursday from Challenger, Gray, and Christmas. The S&P, I also, have to point out that the S&P is dancing along its 200-day moving average, which is an important line in the sand here. So I think investors are still just trying to find their footing with all of these headlines and all of this data coming in. Is this true economic weakness we're seeing, or is this just another head fake? And should we believe Powell here that the economy is fine?
All right, so that's a great question. Should we believe Powell? Should we believe the White House? We're just playing a soundbite from the Commerce Secretary saying emphatically, no, we're not heading towards a recession. The president himself seemed to be kind of hedging his bets. If you're concerned about a possible recession coming up, how should you manage your portfolio?
Well, first of all, I hate that the R word is being thrown around here because it's a pretty serious word. Most bear markets correlate with recessions. You can see that throughout history. I mean, if you believe the jobs numbers, then yes, you should be worried about an economic downturn here. I'll just be honest. I can't sugarcoat it. Unemployment is going up. Layoffs are higher and will be higher in the March jobs report that we'll get in about a month. We're seeing underemployment spike as well. There are a lot of moving pieces here, but I hate that you're seeing weakness in the job market. And I think if you believe that the economy is showing significant cracks at this moment, you have to hug defensive sectors, especially because they have that rate cut sensitivity as well.
What about bonds? A lot of people kind of piling into the short end of the bond curve right now, the 2-year in particular. We're just talking about some of the moves there. And also, you're very bullish. Well, I don't know if you're bullish, but you're saying right now might be a good time to buy tips.
Well, I think I think very bullish is an overstatement.
Right.
I think you have to believe in this bull market here, Frank. I think it's a lot harder to get back into a market than it is to sell, and I know it's easy to sell at the moment. A lot of investors are trigger happy for very good reasons. The bond market is an interesting question right now because we're staring at inflation risks and we're staring at growth risks, and of course there are counterbalances here. If we see more of a breakdown in the job market, then that will naturally help, tame inflation at the moment in the worst way possible. I might add, that's not the right way to tame inflation. But I think in the bond market, you have to be tactical here. Treasuries, of course, are that classic economic hedge. I think you have to look a little more toward the belly of the curve when you're hedging there. But I also think it's important to hold on to tips because as we've seen over the past few months, tips are that hedge against unexpected inflation. And there are a lot of unexpected headlines floating around at the moment.
All right, so tips seem to kind of a safety play right now, but you're also saying stay nimble right now. In your mind, some of these dips we're seeing, are they buyable? If they are, where would you buy?
I think these dips are buyable until we get more information on the job market. Unemployment is still low. Companies are still hiring. That's one of the bright spots that we saw on Friday. I think, of course, we serve longer term clients, so we encourage them to have a wish list here and to think about, what the growth stories could be over the next 5, 10, 15 years. But if you're looking out over the next year or so, I think you have to stay defensive. I think you have to, tilt toward value here, look for the companies and the sectors that are trading close to their earnings and prioritize stability and consistency. We just had 2 years of 20% plus gains in the S&P 500. Don't get too greedy at the moment. Try to preserve what you've built here.
Callie, we got to go, but really quickly, everybody says they're a long-term investor, but even if you're a long-term investor, you do need to make short-term and intermediate moves. Is there one sector right now that you see potentially having the biggest opportunity to buy the dip when it comes to some of the weakness that we've seen?
Well, that's a really good question, and you're right. I guess that goes back to stability and consistency. You can't benefit from a market that you're not invested in. So again, I think you look at the defensive sectors here. You maybe, look at some rate cut plays as tactical opportunities. I think real estate might be interesting at the moment, but you can't expect these trades to play out,
Right.
anytime over the next month or two. You have to be really careful and set your expectations there.